Happy Wednesday out there, Team 42. It's your skipper here, Darius Delta, present our macro minute for Wednesday, September 18th, 2024. It's Fed Day, so we got a lot going on in macro land today. But as always, we'll start with the executive summary from today's Lit Off Morning Note. If you would like to review the analysis supporting these conclusions, as well as what specific changes you need to make in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. So today's key macro questions are: will the Fed's dot plot support market pricing for an aggressive policy normalization program? And what will the economic impact of normalizing policy be? Our answers are: the Fed likely needs to speed up its rate cutting forecast in the dot plot to avoid the perception of tightening policy relative to the pace markets currently think they need to preserve the business cycle. If the Fed is very wrong on its currently low estimate of the neutral rate, then it won't take many rate cuts to cross into outright easing. Moreover, the mere expectation of easing is stimulative in the hyper-financialized U.S. economy, where more than two-thirds of private non-financial sector credit comes from capital markets. We maintain our non-consensus view regarding the medium to long-term outlook for nominal GDP, in that we see it generally surprising to the upside. As such, we do not believe we see bonds generally underperforming stocks over that duration until the Fed signals it is willing to do what is actually necessary to defeat inflation. For what it's worth, we do not expect them to ever do that in this fork-turning regime, and reiterate our structurally bullish bias on risk assets like stocks, credit, commodities, and crypto, as well as our structurally bearish bias on defensive assets like treasury bonds and the US dollar. Transitioning to our 42 macro dashboard, as always, we're wrapping up with the question from our community here. This one's regarding the TED spread. So I'm reading the question here, so it's pretty long, so bear with me. I remember reading in Navigating Bit Debt Crises that one of the many metrics to follow was the TED spread. You can find this metric on Fred. TED spread has been discontinued, but calculated as a spread between the 3-month LIBOR and based in US dollars and the 3-month Treasury bill. As Dahlia writes, the TED spread, which a higher number of banks, which means a higher number, in which a higher number means banks are demanding a higher interest rates to compensate for the risks of lending to each other. It is clear that the top in the debt cycle was being made anyway. Fred says to calculate the new version, you need to take SOFR minus the 3-month T-bill yield, which you can do on TradingView pretty easily. As you can see, it seems to be spiking to concerning levels. How concerned should we be, in your view, since this is just an important one of many metrics to consider? So I don't think this is very important, specifically for the reason that the way banks interact with each other and the broader economy has changed considerably since 2008. So back then there was a lot of unsecured lending, which is what LIBOR was calculating, which is unsecured lending between commercial banks. Right now, there's hardly any unsecured lending between commercial banks. Most of the lending between banks and other financial intermediaries occurs through the repo market, which are secured lending, which is collateralized lending. And so, the rise in the TED spread is not an apples to apples. The rise in the TED spread today, or this sort of version of the TED spread today, which is SOFR minus the 3-month T-bill yield, it's simply not as it's just not as concerning. It's these interest rates are the lending is capitalized, and as a function of that lending being sort of capitalized, you have to understand that there's not as much financial sector risk due to a bank going bust or belly up. So it's obviously not good if the TED spread or if this version of the TED spread is rising, but it's certainly not anywhere close to an apples to apples comparison based on what we saw in 2007, 2008. I think there's been a lot of certainly since the regional banking crisis of many crises in March of last year, there's been a lot of focus on the the health of the global financial sector, and by and large, thanks to Basel III, and I forget what there's some other legislation in Europe back in, I want to say, 2014 or 2015. Both of those two things essentially made banks, they neutered banks and pushed all the incremental financial intermediation activity to the private sector and away from the commercial banks and into the shadows, if you will. And so a lot of that, and I'm not, in our opinion, that actually made the financial sector more resilient because you had a lot more maturity matching with respect to lending and borrowing. And that's exactly what we didn't have in 2007 and 2008. that ultimately led to the global financial crisis and ultimately the Great Recession in 2009. So investors should be aware of that. This is not nearly as concerning as it used to be, and ultimately there's probably better risk metrics to focus on, as specifically the ones we focus on in our research every day here at 42 Macro. So we'll wrap it up there. Darius Dell presenting our Macro Minute for Wednesday, September 18th, 2024. Everyone have a wonderful day out there. Best of luck, and we'll catch you back here tomorrow. Cheers.